Hello once again to day 2 of our 2019 Gold Summit. My name is Boaz Shoshan and I'm about to have a conversation with Ronald Stöferle, who's an Austrian economist, a fund manager, and he's also the writer of the In Gold We Trust report, which comes out annually. I've got the latest copy of In Gold We Trust report here, but the next one will be coming out in May. Now this is a free report that goes out to gold enthusiasts everywhere, has a very broad following, and it's got some great data inside of it. I want to pick Ronnie's brains and find out exactly what he thinks is on the horizon for gold. And in this conversation, Ronnie has agreed to share some of the charts that will be appearing in the next In Gold We Trust report, which will be going out in May. But I hope you enjoy it, and without any further ado, let's get on. Ronald Stöferle, thank you so much for joining me today.
Thank you, Boaz.
Now, you have said that gold is money, then, today, and tomorrow, which is quite different from what you hear from the mainstream investors who think of it as a commodity or just a speculative investment. In terms of how gold functions as money, you have brought us a very nice table showing exactly how gold has performed in many different currencies, rather than simply, the dollar or the British pound. What is it that you take from gold's performance over the years in all of these different currencies, and what is it telling you now about gold itself?
Well, it clearly shows that gold is a soft metal, but a very hard currency, and of course, green numbers mean a positive yearly performance, red numbers mean a negative yearly performance. And what we want to show with this chart is actually for me, being based in Austria and in Liechtenstein, for me the euro price and the Swiss franc price of gold is more important. For the Indian wedding couple, the rupee price is more important. For you over here, the British pound price is more important. But everybody is just talking about the dollar price of gold. So I think it's important to say that actually gold was performing last year pretty well in most currencies. In euro terms, it was up 3%. In dollar terms, it was only down 2.2%, I think. And of course, the fourth quarter was very positive. So gold clearly showed in the fourth quarter, where we've seen a very weak stock market, that it is a portfolio stabilizer, that it is a great portfolio hedge. But as we can see, and we are running those numbers and performance data in our In Gold We Trust report quite a lot, and we've got also longer term comparisons. And it seems that gold is basically a good hedge against monetary inflation. And on average, since 1971, the gold price rises by 8% per year, which is almost exactly like monetary inflation on an annual basis, which is running at 7.5%. So it just shows you that gold over the long term is really protecting your purchasing power, and that's what it's all about. I think that physical gold is something to preserve your wealth, while mining stocks, for example, are great tools to perhaps improve your wealth. But I think it's really important to differentiate between physical gold and mining stocks, because those are really two different motives and risks that you're taking.
Quite. Well, you said gold has risen 8% roughly year on year since Nixon closed the gold window in 1971. Are you meaning that in dollar terms, or are you meaning in fiat currency terms more broadly?
That's in dollar terms, but that's also interesting in Japanese yen terms, and also in euro terms. If you kind of calculate it back, of course, the euro.
What would the euro have been?
Yeah, exactly.
Right.
The numbers are pretty similar. There's one fiat currency that has done significantly better, and it's the Swiss franc.
Right.
And probably the reason is that the Swiss franc was backed by enormous amounts of gold until quite recently. So I think that added to the stability of the Swiss franc.
Quite, and it continues to this day, despite the Swiss National Bank doing all that they can to buy everything under the sun and add it to their balance sheet. In terms of the dollar's dominance that you referred to before, with everybody looking at the dollar price. So last year, if you're a gold investor and you're just looking in terms of dollar terms, you're not seeing some huge rally at all. And the dollar was very strong last year. What do you make? Do you think that trend where everyone looks at the dollar price and they don't look at all the other currencies and see how all of those other currencies are losing value so much? Do you think that that trend will stay in place? Do you think the dollar will remain as this global reserve currency for commodity payments, oil payments, things like that? Or do you think that that is changing? Because we have had, we've had brief discussion beforehand about the de-dollarization trend. And do you subscribe to that kind of to that view that over time the dollar will lose its global significance?
Absolutely. I mean, we are writing about this de-dollarization topic for 4 years now already, and it seems that it's really picking up momentum at the moment. We have seen that, the Shanghai Gold Exchange, and now last year the Shanghai Oil Exchange, for example,
yes.
They introduced an oil contract that is traded in renminbi terms, and they already got 15% market share in the oil market, which is by far the biggest commodity market. Just within 1 year, I think that's really really huge success. We're seeing basically on a daily basis, we're seeing bilateral trade agreements between China and other emerging markets, mostly commodity exporters, where they completely circumvent the US dollar.
Yep.
We have seen, of course, Vladimir Putin criticizing the status of the US dollar as the world reserve currency, but also from the European Union, and I think that's really quite telling. We have seen recently that they said, we are by far the biggest importer of oil. Why do we have to use dollars for that? Why couldn't we invoice everything in euro terms? I think that's really a big thing. Now, the whole de-dollarization, of course, is an extremely political topic, of course, and from my point of view, the whole trade wars are more currency wars. But studying the status and the development of reserve currencies and reading quite a lot of books about that, it seems that there's it takes between 70 to 90 years from one reserve currency to the other. We have seen that during history, and for example, from the British pound being the leading world reserve currency to the US dollar, it took like almost 3 to 4 decades where they basically went parallel.
Before there was a big
shift, basically with the Bretton Woods Agreement, So everybody's saying, that the renminbi will be the world reserve currency very soon. I think that's naive, that's nonsense. But we're seeing big steps into that direction, and I think that gold is playing a major role in this game.
Yes, quite. In a currency war, I suppose if you own physical gold, you're maybe a pacifist or the referee almost.
It's not participating in the currency war.
Because in currency wars, these are countries fighting effectively to devalue their currency against each other and be more competitive.
Absolutely.
In terms of on that note of sort of currency wars and China being this pivotal player now. You've in the In Gold We Trust report before, you have referred to China as the sword of Damocles that is sort of hovering over the global economy. Could you go into a bit about that and why and how gold plays into that as a hedge against that sort of Damocles?
Well, we have seen during the 2008-2009 crisis that the Chinese reacted much more aggressively. So their kind of quantitative easing relative to their GDP was like 5 times bigger than in the US. So that was the main reason why we've seen many commodity markets, most of the economic numbers in China recovering extremely quickly. Now, being a student of the Austrian School of Economics, we can clearly observe that there's a credit bubble in China, perhaps the biggest credit bubble ever. But now it seems that the government kind of wants to deflate this bubble, which is not easy. And we have seen lots of numbers in the last couple of quarters coming out. For example, auto sales for the first time in absolute terms, they were down. First time I think in 28 years. We have seen, Australian market being some sort of a proxy for China being very, very weak.
And Germany to some degree as well.
Germany to some degree, they're very, very close to a recession. So many countries and industries that are tightly linked to China, they are suffering.
Yeah.
Of course, we should take the official Chinese numbers with a grain of salt. I've been to Shanghai in December, and it seems everybody says, business is not going so well, but for the longer term, we will be successful. And the interesting thing regarding China is that actually this monetary U-turn that we're talking about for quite a while now, the Chinese were the first to start this monetary U-turn. So they significantly reduced their reserve requirements. They did massive fiscal stimulus, and I think that's also the reason why most of the commodity markets, most of the inflation-sensitive assets actually stabilized and got stronger. So with this monetary U-turn, topic that we're very vocal about for quite a while, I think we've been pretty right, because now we have seen the last couple of weeks that the Federal Reserve is also beginning this monetary U-turn, which is going to be a very, very big driver for financial markets.
Right. So with China taking the lead there recently, but being the first of the large players. So in Europe, we're seeing similar rhetoric with Mario Draghi talking about taking out the toolbox again for more QE, more money printing, and then the Fed, of course, having this big dovish turnaround. But in your view, that was begun by China. China was the one who first sort of detected this and did a complete switch around. And they're the ones to put on the gas. But put on the gas in this case is pretty bad for the currency, right?
Of course.
And very good for gold, right?
Of course. I mean, it is interesting, and I think that the recession risks are much bigger than most people think. So I've tweeted lots of charts last couple of months with the recession 2019 and hashtag globalized economic weakness and stuff like that, because we are seeing just recently we tweeted that in 95% of all countries on a year-on-year basis, economic numbers are significantly weaker at the moment than 1 year ago. So it's a very broad slowdown, a globalized slowdown that we're seeing. And of course, the main reason from my point of view is that 2018 was basically the first year when we've seen that the liquidity party that we had for 10 years, and I mean the biggest central banks, they created 18 trillion US dollars out of thin air. But on a net basis, 2018 was the first year in a decade that they actually reduced balance sheets. And we have seen in the US with quantitative tightening being 420 billion in 2018, 2019, it's supposed to be 600 billion. That's quite a lot of money. And it's not only the Federal Reserve that is becoming more hawkish, it is also to some degree the Bank of Japan. It is the European Central Bank, but there, I mean, the party hasn't really ended, and Draghi is already talking about the next liquidity party. Yeah. So this end of this liquidity happy hour, let's put it that way, that's really a big topic, and it shows and it confirms our views how addicted the market is to cheap liquidity, to low rates, and central bank expansion. Yeah. So I just wonder, I mean, the Federal Reserve has got some leeway to reduce rates, to pause QT, and at some point I'm absolutely certain they're going to introduce a new round of quantitative easing. Perhaps the name will be different, but it will basically be the same. And on average, interest rates are lowered by 500 basis points within the course of a recession.
Yep.
I just wonder what Mr. Draghi is going to do, or his successor, because there's actually no real room to maneuver.
Because rates are already negative, yeah.
Exactly. So that's all kind of the perfect storm for gold from my point of view.
Right. So yeah, you mentioned the big U-turn that had been made, effectively starting with China, but then rippling through the Fed. I mean, how quick will that U-turn turn into, say, the Federal Reserve, cutting rates, cutting rates from what little they have down to nil, and then starting a new round of quantitative easing? Because I mean, quantitative tightening, they referred to it as something that no, this thing's on autopilot, and we're not going to be starting any more quantitative easing. I mean, how long do you think they can continue to get away with that? So you said 2018 was sort of the first year when central banks had kind of reduced the amount of punch in the bowl for markets, really. How long do you think they can continue removing the punch?
Well, I think the way this U-turn was already started, it is surprising for me that it took so little for the Fed to pause, actually, because like November last year, everybody was expecting, or the market was expecting, 3 or 4 rate hikes, and of course quantitative tightening.
Yep.
Now we're a couple of weeks later. We're at this stage when nobody is expecting a rate hike this year. Most of the market participants are even expecting falling rates next year. And I think the consensus nowadays is that they're gonna be some sort of flexible regarding quantitative tightening. So I think this changed quite quickly. Of course, they cannot say, like, in the next couple of weeks, okay, we'll lower rates and we'll stop QT and implement another round of QE, because that would show the emperor has no clothes at all. But we can see that this process is happening, and this process, I think, is clearly discounted by the gold price. I think this is really the main driver for gold holding up so well at the moment. It is discounting that we're on the way to lower rates, to more fiscal stimulus, to more monetary stimulus, to more quantitative easing and whatever. I mean, the IMF just came out with the suggestion to implement negative rates again. Those are kind of test balloons. But I think the trial balloons, let's say the toolbox of financial repression is quite big, and there's some
gold has plenty of way to go to offset that, really. Yeah. It's interesting. Something I noticed just recently, before when I was preparing for this interview, actually, because I know how you guys can compare gold as a monetary asset against all the different currencies, much more than sort of the mainstream financial press do. And I was looking at the Swiss franc, the Japanese yen. It seems really quite clear that these safe haven currencies, well, I mean, a big boom started for gold in September, October, really, last year. But it's not just there. I mean, September, October, gold started really doing well in things like euro, in British pounds as well. It seems that the gold market was pricing this kind of thing in all the way back then, which I guess is kind of around the time when from the very early sort of warnings that more money printing was on the way, really, which I thought was quite interesting, especially when it's the safe haven currencies, which is what everyone is meant to go into. Everyone wants to buy francs, yen, and dollars during a crisis. Gold is becoming more and more expensive in these things. They are losing out relative to gold. Going back to China as the sword of Damocles, what is the big risk that you see there? Is it going to be a slowdown in China slows down the rest of the world? Could it be China moving from a pegged currency to a floating currency and exporting deflation around the world? How is it? What is the big risk, do you think, from China?
Well, I think it's obviously an implosion of this credit bubble. And I think many people are very, very much concerned about that. Actually, I think as it's not really an open market or open economy, that could affect the currency, of course, as it often does. But it seems that actually I'm not that concerned about China anymore at the moment. I think that the recession risks actually in the US are significant. They're kind kind of undervalued, or nobody is really talking about the recession risks at the moment for the US. Yeah. It's still kind of Goldilocks scenario with price inflation being pretty low, with economic growth being, you know, between 2.7 and 3.5%, something like that. Employment data coming in really strongly, but if you look below the surface, it seems that there's many recessionary risks appearing. Yeah, we just had the retail sales that were extremely weak. We're seeing for the employment data that it's significantly weaker than many people would think. Of course, we have seen the revisions to profit numbers that were extremely weak. So the companies are becoming much more bearish, actually. And that shows me that while everybody was looking at China and everybody was scared of a slowdown in China, I think more people should really focus on the US at the moment. Yeah.
Right.
And that's a topic that, of course, is linked to this monetary U-turn that we're seeing, because, of course, if the recession clouds become darker, it is pretty obvious that the Federal Reserve will continue with this U-turn.
Right. In terms of how bad do you think it could get for the U.S.? Do you think they'd manage to get away with sort of a minor recession because the Federal Reserve does have a bit of leeway, or do you think that this could quite quickly escalate in something worse? Because the big boom in credit, as we were looking at with China. I mean, there's been a massive boom in the issuance of corporate credit in the States.
Yeah.
How do you think it will play out?
Well, I think one of my top words in the financial bullshit bingo would be soft landing.
Right.
Everybody wants to see a soft landing,
but
yes. In reality, it just doesn't work out like that. So although everybody is talking about a mild recession in 2021 or 2022, because everybody is seeing the recession on the horizon, but not really happening soon. I think it's not gonna play out that way. And don't get me wrong, a recession is something normal. It's actually something very positive for an economy. Recession is nothing else than a reallocation of resources. Yeah. And this reallocation of resources is important for the structure of our economy, for the structure of our capital structure. So the longer you try to delay this natural recession, the worse it will get. And of course, we have tried to delay this big recession, this big reallocation for many years now. We have tried that with extremely low rates, with massive money printing on a global scale. So that clearly shows that the reallocation will be pretty big going forward.
Similar to maybe delaying a forest fire from occurring.
Exactly. But the thing is, when people talk about financial crises, I think everybody compares the next crisis to the last crisis, and from my point of view, 2008, the next crisis, whenever it's going to start, is not going to be like 2008. It will not be only a financial crisis. I think it might be a monetary crisis, actually. And it might such big events often get solved with big agreements, whatever it is on a global scale, and I think the next crisis might really be a monetary crisis where gold will be remonetized. Jim Rickards, who's on our advisory board, he always says that if you want to play poker with the big guys, you have to bring chips to the table, and those chips are golden. So it's no coincidence. I mean, the US has 8,100 tons of gold. Of course, there are lots of rumors that it's not there anymore. I haven't seen it, but I think it is still there. The Euro system holds more than 10,000 tons of gold. The IMF holds, I think, 3,500 tons of gold. So from the Western world, the main players they own some chunk of gold. And for the Eastern world, I would say, for the emerging markets, they've been really active in the gold market. So we all know that Chinese have got significantly more gold than they officially announce. Ricketts calls it the axis of gold. So China, Turkey, Iran, and Russia, they're all buying significant amounts of gold every month. Actually, Russia has their backing of their M1 monetary aggregate is roughly 50%. So you could make the case for a kind of a gold-backed ruble. And this shows me the Western world holding quite a lot of gold, and emerging markets adding constantly, piling on. That shows me that everybody is aware of the significance of gold, and once they meet on the poker table again, I think they will come to a conclusion that gold has always been some sort of the monetary backbone of currencies. And whatever it will be, I mean, many people would advocate for a gold-backed SDR or something like that. I've got some theories, but it's hard to make a forecast on that. But I think that in the next monetary system, gold, of course, will play a major role again.
In terms of your theories, so do go on. I'd be interested. I'm sure we'd all be interested to hear what those might be. So you referred to the special drawing rights of the IMF. Because they create reserve rights and reserve assets for various countries to use. How do you think when all of the players come back to the table, how do you think that new currencies backed by gold would be created?
Well, I mean that's really hard to answer. I think that with the papers coming out in the last couple of years, kind of discussing the importance of the SDR, with the renminbi being included in the SDR, with lots of comments by Madame Lagarde, for example, about the significance of the SDR and how it can help in the course of a crisis. I think that it is some sort in the, how would you say that it's like one of the tools that central bankers and politicians might use in the next crisis. I think we have seen from every crisis to the next crisis that the problems got bigger, that they became basically more global, and that the measures that were taken became much more aggressive. So the introduction of the SDRs as some sort of new global currency, I wouldn't rule that out. At the moment, it kind of it sounds quite weird. Because nobody actually knows what an SDR is, and I know only a couple of economists who really can explain the SDRs. But it is interesting to see that actually SDRs as a currency are used in quite a lot of international contracts. For example, in the shipping industry, in the flight industry, they're using SDRs already. In the insurance industry, so it is already used. But, and that's what Peter Miller once said when we had a chat about the history of currencies. He said, money used to be I owe you gold. Then with Bretton Woods, or the end of Bretton Woods, it became I owe you nothing. And the SDR would be who owes you nothing. Yeah.
Quite. That's a great progression, isn't it?
So actually, it's really tough to see how it's all gonna play out. But I think that the SDR will play a major role in a new currency regime. But most importantly, and I think if you study history, monetary history, and currency or global reserve currencies, I think always in this period from one reserve currency to another, gold always played a major role, and it's no coincidence that our gold report is called "In Gold We Trust," because when they introduced the euro, for example, they always advertised to create trust that the Eurozone holds more than 10,000 tons of gold, so that there's some sort of a gold link to the euro. And therefore, when a new reserve currency or a new global currency, whatever, is introduced, I think gold will be very, very decisive to create trust in this new currency.
Right, right. On the topic of currencies, you said the next crisis would not be like 2008, and it would be a monetary crisis. By that, are you referring to a collapse in confidence in fiat currency, or do you mean something else, or a collapse in the confidence of central banks to keep everything, all the balls in the air?
Yeah, probably that, and we're seeing, you know, I think with those populist movements coming out all over the globe, yeah, on the very left wing, but also on the very right wing, yeah, and I see really that there's no discussion anymore, yeah, between
completely polarized.
Yeah, it is. That's a very, very negative sign, and from my point of view, many things that we're seeing in our daily lives can be kind of attributed to our monetary system and the flaws of our monetary system. Yeah, I had a chat with the Uber driver yesterday about. He said that, you know, the Brexit is a great thing, and that the European Union is responsible for all the mess that he's in, yeah, and that the UK is in, and the working class is in. And I said, you know, yeah, that's your point, but my point would be, let's talk about our monetary system and the Cantillon effect, for example. So people profiting from monetary inflation while others are suffering from monetary inflation. So I think that, you know, with Occupy Wall Street, for example, yeah, everybody kind of forgot about that, yeah. That was pretty civilized, yeah. But if you now see the riots like the Yellow Vests in France and all those movements coming up, yeah, I think really like social issues and kind of social riots will of course become bigger, because if you look at many different numbers since 2008, 2009, the money that was created, it increased this huge gap, this wealth gap significantly, yeah, and of course we have seen, so there was monetary inflation, and then there was asset price inflation, yeah. Real estate prices all over the globe are going crazy. We're seeing that the art markets, bond markets, whatever, prices are significantly rising, and of course there's people profiting from it and people suffering from it. So long story short, I think that those social consequences, yeah, are very, very important to consider when we're talking about money and our monetary system. And therefore, I think that, you know, gold is actually, you know, if there would be a gold standard, yeah, I think our system would be completely different. I think it would be much healthier. I think that, you know, just when it comes to war and peace, yeah, with a gold standard, you really cannot fight long wars, yeah.
Yeah, because it's unaffordable.
Exactly. Right. Yeah. So I think that the consequences of our monetary system is really something that let's say the left-wing populists should take into account. I only see okay, we should introduce 80% income tax, stuff like that coming from the Democrats in the US.
Oh, yeah,
but nobody is talking about our monetary system actually, yeah. And I think this discussion would be much more important.
Quite. It seems some of the populist movements, it is less. While it began as, you know, very, very critical of the status quo, it seems with some of the movement that they're actually interested in getting control of the printing press, and being able to make all the promises they want in their manifestos, really, I suppose. In speaking of sort of going back, the return to a gold standard and the possible return to a gold standard, one of the charts that you were so kind to bring with you today it's a graph of the how much gold backs the US dollar, and how expensive gold would need to be in order to back the dollar again. So it's a very interesting curve. In terms of how expensive you reckon gold would need to be, or in a new monetary system, or if it was just backing the dollar and keeping things as it were, how expensive do you think it would be?
Well, actually, the monetary backing of the US dollar is extremely low at the moment. Yeah?
Tiny,
So,
yeah.
so you could make the case that gold is actually as cheap at the moment like in 1999 when the last big bull market actually started, or in 1971 when the really big bull market started from 35 to 850. So because of all the central bank printing, gold actually got cheaper, yeah, in monetary terms. That's what we want to show with this chart. And we're calculating in the 2018 report the shadow gold price. So in the Bretton Woods agreement, gold wasn't backed 100%. Most of the time it was 40% and then 25%. Yeah. So we're basically calculating where the price would be with that sort of backing, and we're not only calculating that for the US but also for the world. And of course, those numbers are really big, and nobody could believe them, because my long-term target has always been 2,300 US dollars, and everybody said, you know, that's crazy, that's way too high. But actually, if you calculate this shadow gold price, yeah, and you come to let's say 40% gold backing, yeah, you arrive at 6,000 to 8,000 US dollars pretty quickly. Yeah. So from my point of view, if there should be some sort of a reallocation or a new monetary system that kind of revalues gold, gold prices would probably be above 10,000, something like that. That it's not my official forecast, yeah. But based on history, those numbers are pretty clear. But for the investor, I think it's important to say, okay, gold in nominal terms was basically going lower to flat the last couple of years, but actually in monetary terms it got even bigger. It's really a bargain at the moment because there was so much printing going on, and that's from my point of view, that's how we understand gold. We're seeing it as a monetary asset, and therefore you should always compare basically the let's say the stock to flow ratio or the annual inflation of gold versus fiat money. And
so annual inflation of gold being the amount of gold being pulled out of the ground and refined, relative to the amount of new money that is being created by central banks.
Exactly. We are producing a great chart for the next gold report that will be published end of May.
Looking forward.
Where we show the annual gold production, which has been rising the last couple of years. Everybody's talking about peak gold, but we don't see it, and I think I'm not really convinced of the peak gold theory. But you can see that gold production is rising, but relative to the total stock of gold, it's like 190,000 tons of gold that were mined throughout the centuries, yeah, that are still available. Actually, this inflation, so this new production, is 1.6%. So even if production would double tomorrow,
yep,
inflation of gold, of your ounce of gold, would only be like 3%. Yeah, and this trust that actually nobody can inflate your gold at will. That's actually something that makes it so special. So the stock to flow ratio is something that really everybody should understand. Yeah, we're one of the few ones that really explain this stock to flow ratio, and kind of the delta between the annual inflation of gold, which is 1.6, and the annual inflation of monetary aggregates, which is around 8%. That's actually the long-term price rise of gold, yeah, or probably that's official inflation. Yeah, we all know that, real inflation. That's what I want to say. We all know that inflation numbers that are calculated are you can question that.
Yes. Yeah, quite.
So I think that actually inflation probably is between 6 to 8%. Of course, it's highly subjective. It depends on your spending and whatever. Yeah. But if you include real estate and so on, I think 6 to 8%, which is monetary inflation. That's pretty close what it really is.
Yeah, by comparison, an inflation of 1.6% looks, would feel a lot better in your portfolio. And speaking about gold as cheap, one of the charts that I found quite interesting that you published, and which a colleague of mine, Nikolai Hubble, has referred to in the past as well, is the chart of the American stock market to commodities in general. And in that chart, you have the oil crisis, the Gulf War, and the global financial crisis as these great peaks in the ratio between the price of commodities and the price of stocks. And then at sort of the end of the dot-com bubble, there was this great trough in the middle. And now the ratio as a whole is now incredibly low. And so and it seems to have almost just be slightly curving up at the very end, maybe hinting that a big boom of commodities against the stock market is on the way. What do you make of the aggregate commodities space in general?
Well, I think this chart is one of the most quoted, unfortunately also one of the most stolen charts that we ever produced.
Right.
And we have to give credit to Thorsten Denin, a friend of mine, who originally created it. I think it's a fabulous chart, and for me and for us also in our investing, it's important to really understand the long-term dynamics and the long-term trends. And you can see that, of course, those peaks and troughs in the ratio, they coincide with dollar strength and dollar weakness. So at the moment, we're basically at the same level like 99, 2000, and also like in 1971. And after those periods, we have been in severe dollar bear markets. While on the upper range of this ratio, you can see that dollar bull markets started. So I think the conclusion from this chart would be, first of all, that commodities are extremely cheap relative to the US stock market, but also that we might expect a dollar bear market. And from my point of view, I've got friends and colleagues in the industry that are extremely dollar bullish. Like Brent Johnson, for example, and they're making a great case for that. But from my point of view, actually, the whole world wants and needs a weak dollar.
A cheaper dollar, yeah.
And that's actually something that Donald Trump is, I think, pretty concerned about. The strength in the dollar that we've seen last year, it created negative consequences for emerging markets, for Turkey, for example, but also for Brazil. And we could see that with the weaker dollar the last couple of weeks, those emerging markets kind of came back. We have seen that Donald Trump, he put enormous pressure on the Federal Reserve. I mean, that was quite a big thing from the White House, not only from Donald Trump, but also from Steve Mnuchin, criticizing Jay Powell and the Federal Reserve that they are too hawkish, that they are destroying the US economy and the stock market and so on. We haven't seen that for decades. So from my point of view, Donald Trump, he desperately needs a weak dollar, and he will try everything to get a weaker dollar. Of course, if there should be some sort of a financial crash, that would probably create more interest in the US dollar as classic safe haven currency. But we have also seen, like beginning of last year, when there was a pretty big volatility end of January, beginning of February 2018.
Volmageddon.
That actually the dollar didn't go stronger, but slightly weaker in the course of this crisis.
And the US Treasury as well wasn't bid as much as it was.
So those patterns and correlations, they're changing at the moment, it seems.
It's interesting where you say the rise and fall of the grand commodity cycle of commodities against stocks is whenever they were at great peaks. That was a time of dollar weaknesses, and then when they ended when the dollar strengthened again.
Yeah.
And I think that refers a bit back to our earlier discussion where we were just talking about how the dominance of the dollar over commodities in general, in oil, things like that. In theory, I mean, if the dollar, if we do see more de-dollarization and we see the pricing of other commodities in other currencies, do you think that this will cease to be quite so good of an indicator, or do you think that because it is just stocks to commodities rather than well, the ratio is specifically stocks to commodities, or do you think that that ratio will still sort of remain peaking and troughing as it has before?
Well, I think if other currency blocks and countries decide to not price their commodity trade in dollar anymore, of course this will have an impact, and there will be significantly less demand for US dollars. And I think it's important to say that the dollar, having this status as a global reserve currency, it's extremely important for the US, and actually I think it's no coincidence that the US has by far the biggest military budget, and that of course those, what is it, 800 billion per year is basically also to defend this currency regime that they're profiting from a lot. So I think it would be naive to say that the whole de-dollarization topic only has got financial consequences. It has massive political consequences, and might lead to, I really don't want to be a fear-mongering, but this is something that really might cause wars, and we're already seeing that this kind of end of the globalization that we're seeing at the moment, and I think that's a big trend. This already kind of leads to different blocks. Of course, the US and China and Europe kind of in the middle. Just have a look at this speech by US Vice President Mike Pence. About the new China strategy at Hudson Institute. I think everybody should have a look at that. That's actually really scary. So of course it will have financial consequences, the whole de-dollarization, but we should not rule out that there will be severe political consequences. We shouldn't see those topics too isolated.
As mutually exclusive. On the topic of ratios, in terms of the, so we're speaking about stocks and commodities, but within the commodity space, what do you make of the current state of play with the ratio between gold and silver? Because at the moment, we're seeing quite an extreme in the difference between the price of gold and silver, where historically they've traded at a much higher average, really. What do you make of it all?
Well, in general, just to explain our way of thinking, I think, in a world that is so massively influenced by monetary expansion, by monetary inflation, I think ratios, so relative prices, give you much more information than absolute prices. So for us, it's important to show the long-term trends. For example, in the gold-oil ratio, gold-platinum, which is a great recession indicator, for example. Gold to stocks, gold to the bond market, and so on. But also gold-silver, because silver, if you put it that way, silver is probably the ultimate sentiment indicator for gold. Most people that have been bearish are bullish on gold. At some point they became kind of extremely positive on silver, saying, okay, gold-silver ratio has to come back to 15, which is the long-term historic average. For us, it is very important in our investment process. The gold-silver ratio plays a major role in our incremental inflation signal, for example, because it shows, first of all, the sentiment, but it also shows the strength of the trend. And normally, when we are in a gold bull market, silver should outperform gold, so the ratio should be falling. And we have seen that at 80 to 83, there was like a massive resistance. So silver was extremely cheap compared to gold. You could buy 83 ounces of silver for 1 ounce of gold. And if our assumption is right that we're in a new bull market for gold, then the gold-silver ratio should come down significantly. So I know only very, very few gold bulls at the moment, but I think all silver bulls, they're, I don't know, they're hiding. And it seems that, you know, with World Gold Council came out with their demand numbers for 2018, and actually investment demand in the gold space in ETFs, for example, it was like, I think, 4 or 5 billion, which is nothing, yeah. But the silver market is much smaller. So from my point of view, if we're really in the second part of this trend based on a Dow theory, so the first phase is the accumulation phase, where everybody is bearish and only contrarians are buying into an asset, whatever it is, if it's gold, stocks, whatever. Then the second phase is the public participation. That's the longest phase. And from my point of view, we're at the beginning of this public participation phase. And then the third phase is the distribution phase. The mania phase, like, you know, cryptocurrencies, end of 2017, yeah, gold in 2011, yeah.
Where the contrarians at the beginning who were accumulating start cashing out.
Exactly. So the fact that, you know, at the moment it seems the media is getting a bit more positive. It seems that the Wall Street banks aren't that bearish on gold anymore. It seems that many investors are waiting on the sideline at the moment, but they want to enter the gold trade. Yeah, at 1360, 1380, there's a big resistance, but once we're above that, we can easily go to 1450, 1500 within a couple of weeks. From my point of view, there are basically no technical resistances there. So I think if that should really happen, yeah, that the trend is picking up momentum, then people will kind of reconsider silver. And as silver is such a tiny market, from my point of view, if there's investors' demand kicking in, I think the supply-demand imbalances will create significantly higher silver prices. So the gold-silver ratio should actually fall, and silver should outperform gold.
Right. Now, in terms of, well, we're speaking a bit on silver, and you mentioned the gold to platinum ratio there a bit. In terms of, in one of the charts that you brought along, the ratio as a whole generally anticipates recessions. Would you like to explain how exactly that works?
Well, gold has got, I would say, a very low correlation to, or a low demand from the industry. It's roughly 10%, and it's fairly stable, while the rest is jewelry and investors' demand. While platinum is of course, it's very much of an industrial precious metal.
Yep.
Yeah, of course, the car industry is very important. So I think it's also kind of a safe haven versus the economy ratio. And normally, if that ratio rises, so if gold outperforms platinum, it shows times of economic stress, of recessions, and we have seen that quite recently. So from my point of view, and that's a very important finding of our last gold reports, because we always really want to show our readers and especially also the financial community. Yeah, it's not about 100% gold. Yeah, but it is about how gold really works in your portfolio, and if the allocation is 5, 10, 15%, that's up to you and up to your preferences. Yeah, and your rest of your portfolio. But it's absolutely clear that gold improves the characteristics of your portfolio. So what we did in the last gold report, we had a very close look how gold actually performs in recessions. And the answer is crystal clear. It develops extremely well. Gold is one of the very few assets that perform well in the course of recessions, because gold kind of anticipates that there will be monetary stimulus and that there will be fiscal stimulus. So in this phase, like the beginning of the recession up to the moment when it is officially announced, that we're in a recession, that's the best phase for gold, because it kind of discounts what measures will be taken. And this is something that I think fits pretty well to the current environment, where gold already discounts this monetary U-turn that we talked about, economic numbers coming in weaker, and this global slowdown that we're seeing. I think this is perfectly reflected by the gold price.
Right. Well, Ronnie, it has been a pleasure speaking to you today. In terms of how viewers might be able to get a read of the In Gold We Trust report, and in general what you guys do at Incrementum, we'd like to tell them exactly what you guys are about.
Yeah, well, Incrementum is based in Liechtenstein. We're equity partners from Switzerland and from Austria, and we met basically in the middle in Liechtenstein.
Right.
One of the very few countries on earth without any government debt. It's from my point of view the most stable jurisdiction in Europe. It's a great country, but it's also a very small country, 35,000 people living there.
Yep.
And what we do at Incrementum is, first of all, wealth management for high net worth individuals. Then we're doing asset management, fund management, mostly I would say in the real asset space, commodities, precious metals. And then we're doing the research, the In Gold We Trust report. Next one will be released 28th of May. And we also publish the cryptocurrency report on a quarterly basis, because from our point of view, it is really important that people discuss money again. What is money? What is good money? What is bad money? And therefore, I think cryptocurrencies are a great innovation, and we've been following the crypto space for quite a while. So we're coming out with this crypto research report that is highly successful. And yeah, for the In Gold We Trust report, that's basically my baby, together with my colleague Mark Walek. We're publishing it for 12 years now. The last one was read by roughly 1.7 million people. There is a German version, there's an English version, and for the first time now in 2019 there will also be a Chinese version, so there will be a Mandarin translation. Yeah, and it's quite a lot of work actually, but I really love working on the In Gold We Trust report, because it's our passion. It's what we really enjoy doing, crunching the numbers, researching, distilling information, and it makes us kind of proud that the gold report is nowadays really read all over the globe.
Yeah, it's if you've been watching this today, you'll no doubt be appreciating some of the charts that are included in Gold We Trust. And if anyone viewing would like to take a read of it, you can get it for free from ingoldwetrust.report. And if you'd like to know more about what Ronnie and his colleagues do at Incrementum, you can find that at incrementum.li, I believe, and add /en for the English version. But Ronnie, thank you so much.
Thank you very much. Thanks.
Well, there you have it, folks. That was Ronnie Stöferle from Incrementum and In Gold We Trust. Now, the In Gold We Trust report will be going live in May. It was very nice of Ronnie to bring along some of the charts that will be included in that, give us a sneak preview. But that's all we have for today. Do be sure to tune in tomorrow. Owen Tracy, it was his idea to have this summit in the first place, he'll be doing his keynote address on what he thinks is the best investment to be making in the gold space. So do tune into that. That's all we have for today. Thank you very much for watching.